Most financially successful families do not think they are making major mistakes. That is what makes this so interesting. From the outside, many households look like they are doing everything right. Good income, steady investing, professional advice, a portfolio that looks diversified, a general sense of responsibility. And yet, over time, some families become more resilient, more flexible, and more efficient. While others, even with solid earnings and decent assets, end up with more friction, more tax drag, and less room for error. That difference is not always about intelligence, and it is not always about access to better investments. Often, it comes down to something less visible: how the system behaves when pressure shows up. That is where elite families often invest differently, not just in what they own, but in how they structure decisions, how they prepare for stress, and how they reduce the cost of normal human behavior. Because the biggest threat to compounding is usually not one dramatic mistake, it is repeated interruption, and that matters more than most people realize. Morningstar's 2024 Mind the Gap study found that over the 10 years ending December 31st, 2023, the average dollar invested in US mutual funds and ETFs earned 6.3% per year, while the average fund itself returned 7.3%. That gap mostly came from investor behavior, from timing, from buying and selling at the wrong moments, from decisions made under stress. In other words, behavior quietly reduced returns, and that is why this topic matters. So, in this video, I want to show you how elite families often invest differently than financially successful but more conventional households, and why a lot of what they do makes sense psychologically, not just financially. First, they do not treat discomfort like an emergency. The first difference almost never shows up on a performance report, but it shapes almost everything. Elite families do not eliminate fear. Nobody does. Difference is that better systems make fear less expensive. And that matters because most investors do not react to volatility like machines. They react like human beings. For many people, money is not just capital. It also feels like safety. So when markets fall, the reaction is often emotional before it is analytical. Psychology has a name for part of this: loss aversion. Losses tend to feel more painful than equivalent gains feel rewarding. So a 20% drawdown does not just look bad on paper, it feels threatening. And once something feels threatening, another psychological pattern often shows up: action bias. The urge to do something, anything, move something, sell something, get safer, call the advisor, make the discomfort stop. That reaction is completely normal. It is also one of the most expensive instincts an investor can have, because compounding does not only depend on what you buy, it also depends on what you interrupt. And this is where elite families often have an edge, not because they feel less discomfort, but because their systems are built to reduce the odds of reactive decisions. They create more structure before stress arrives, more liquidity planning, more diversification, more coordination, more rules around what actually deserves action. That is a psychological advantage, because when stress rises, human judgment usually narrows, attention gets shorter, time horizons get shorter, and the need for relief gets louder. So the family that already decided how it will respond to volatility usually does better than the family that improvises in the middle of it. That is not just discipline, it is good decision architecture. Second, they diversify across failure modes, not just ticker symbols. Most investors think diversification means owning more things: different sectors, different funds, different geographies, a cleaner pie chart. That is fine as far as it goes. But sophisticated portfolio construction asks a deeper question. What, breaks together? Because if everything you own fails for the same reason, then you are not as diversified as you think. You are just spread out inside the same risk. At the high end, investors often think less in labels and more in failure modes. They want assets that respond differently to inflation, liquidity stress, credit tightening, forced selling, and valuation compression. That sounds technical, but there is also a strong psychological benefit. When everything you own moves together, every downturn feels bigger than it really is. That increases the odds of panic, bad timing, and emotionally driven changes. But when assets behave differently under pressure, your judgment has a better chance of surviving volatility. So diversification is not just about protecting capital, it is also about protecting decision quality. And that matters because stress changes perception. When people feel cornered, they often see fewer options than they actually have. Psychologists sometimes describe this as stress narrowing attention. The world starts to feel simpler, more urgent, and more binary than it really is. That is why a badly built portfolio can make people behave worse. Not just because it loses money, but because it makes everything feel like one giant threat. UBS's 2025 Global Family Office report showed that US family office portfolios were reported as 54% alternatives, including 27% private equity and 18% real estate. That does not mean a high-earning household should try to copy billionaire portfolios. That is not the point. The point is that elite investors often spread exposure across different kinds of risk, not just across more public market ticker symbols. And psychologically, that makes the whole system more stable. Third, they do not assume the most comfortable decision is the best financial one. This is where a lot of expensive mistakes happen, because many bad financial decisions do not feel reckless, they feel responsible. Selling an appreciated asset to raise cash is a good example. It feels clean. You need liquidity. You sell something. Problem solved. But financially, that move can be more expensive than it first appears. And psychologically, it can also feel attractive for the wrong reason, because people are often drawn to what feels familiar, direct, and easy to explain. That is one version of familiarity bias. Sometimes the most familiar move feels safest, even when it is not, the cheapest. The IRS is clear that if you sell appreciated assets, you may trigger a taxable gain. So sophisticated planning often compares multiple liquidity options before triggering a sale. Maybe selling is right. Maybe cash flow covers it. Maybe existing liquidity covers it. Maybe borrowing is worth evaluating. Not because borrowing is always smart. It is not. Regulators have made the risks clear. But the deeper point is psychological. Sophisticated investors are often better at separating the question, what feels clean, from the question, what is actually optimal? That is a big deal, because investors do not just make mistakes when they are emotional, they also make mistakes when they confuse emotional clarity with financial efficiency. And another bias can show up here too, status quo bias. People tend to default to the familiar path, especially under uncertainty. Selling is familiar. Comparing multiple liquidity structures is slower, less intuitive, and more cognitively demanding. So many financially successful families never even ask the second question. Elite families usually do. At the top end, public disclosures sometimes show versions of this logic. Oracle's 2025 proxy says Larry Ellison had 346 million Oracle shares pledged as collateral for certain personal indebtedness, while also noting those shares were not pledged for margin accounts. That does not make billionaire structures a template for financially successful but still conventional households. But it does reinforce the broader idea. Sophisticated liquidity planning often looks very different from simply selling assets whenever cash is needed. Fourth, they build systems that reduce human error. This may be the biggest difference of all. Many financially successful families do not lose ground because of one giant mistake. They lose ground because tax, legal, and investment decisions are made in separate rooms. Each advisor may be competent. That is not the problem. The problem is that a disconnected system makes human error more likely, because when no one is coordinating the whole picture, each decision gets made in isolation. And isolated decisions tend to become short-horizon decisions. That creates drag. A little extra tax here, a missed planning opportunity there, an outdated estate structure, a liquidity decision that looked reasonable in the moment but was never compared against better options. This is where psychology matters again. High-functioning elite families often use what psychology would call pre-commitment. They create structures, rules, review cycles, and coordination before emotion has a chance to take over. That is powerful, because the goal is not to become perfectly rational. The goal is to make bad decisions less likely when conditions are imperfect. In other words, the system carries some of the discipline, so the individual does not have to carry all of it alone. That is a huge advantage. UBS found that just over half of family offices surveyed globally had succession plans for family wealth, and among those that did, 64% said the biggest challenge was ensuring wealth transfer in the most tax-efficient manner. So even at very high wealth levels, the issue is not just, what should we invest in? It is also, is the structure current? Are the right people coordinating? Have the key decisions already been thought through before pressure shows up? That is the difference between having assets and having a system. Case study. Imagine two families. Both are responsible. Both are intelligent. Both want to protect what they have built. But they are not operating from the same level. The first is an elite family. They have substantial wealth, broader access to specialized advice, and a system designed to coordinate tax, legal, investment, and liquidity decisions together. The second is a financially successful family. They earn well, save consistently, invest responsibly, and from the outside, appear to be doing many of the right things. But their financial life is still built in a more conventional way. Their portfolio may be diversified on paper, but much of the risk still behaves similarly under stress. When markets fall, anxiety rises, and they react. When they need cash, they sell appreciated holdings because that feels practical and familiar. Their tax professional files returns. Their estate attorney drafted documents years ago. Their advisor sends polished reports. Nobody is fully coordinating the whole picture. Every individual decision looks reasonable. But over 10 years, those decisions compound into drag. The elite family operates differently. They spread risk across things that fail for different reasons. They think about liquidity before it becomes urgent. They review the structure before the pressure arrives. And their tax, legal, and investment professionals are solving the same problem together. 10 years later, the difference is not just account value. It is the structure underneath it. One family has more flexibility, lower drag, and more room for error. The other still has assets, but less coordination, less efficiency, and more hidden fragility. That is usually how the next decade gets shaped. Not by one dramatic decision, but by a series of normal-looking decisions that quietly compound. Self-diagnosis. So how do you know if this pattern is affecting you? If your first instinct during a market drop is to change something, pay attention to that. That may be loss aversion and action bias talking. If your diversification mostly means owning more ticker symbols, that may be leaving your judgment exposed, not just your portfolio. If selling feels more natural than comparing multiple liquidity options, familiarity may be driving the decision. If your plan depends too much on making the right call in real time, that is usually a system problem. And if your advisors are good individually, but rarely think together, that may be where the real drag is coming from. The goal here is not guilt, it is clarity. Because clarity gives you a chance to improve the system before pressure exposes its weaknesses. Because in the end, this is not just about investing, it is about whether your financial life becomes more resilient over time, or more fragile. The strongest families do not win because they are fearless. They win because they build structures that reduce the cost of normal human bias. They make it easier to stay rational when emotions get loud. And 10 years from now, that may matter more than almost any single investment choice.